Today, we're going to talk about a giant in the world of finance, a single number that Wall Street has leaned on for decades as its go-to measure for risk. We're talking about beta. But as we're about to see, this beautiful, elegant little number, well, it might just have a fatal flaw. So let's just jump right in with a huge question. What if I told you that the number one tool for measuring risk in the stock market, what if it's built on a foundation of sand? And look, this isn't just some boring academic debate. This has massive implications for how every single one of us should think about investing our money. All right, so let's get on the same page. What even is beta? Put simply, it's a number that's supposed to tell you how much a stock zigs and zags compared to the overall market. It's designed to measure a very, very specific kind of risk. And to really get beta, you first have to get the theory it's built on. To really appreciate why beta became so popular, you have to see just how clean and simple the theory behind it is. I mean, it's really elegant. And it all starts by splitting the idea of risk into two different buckets. Okay, so here are the two buckets. On one side, you've got unsystematic risk. Think of a CEO getting into a scandal or a factory burning down. That's a disaster for one specific company, right? But you can pretty much get rid of that risk by just owning a bunch of different stocks. You diversify it away. But then there's systematic risk. We're talking recessions, interest rate changes, things that hit the entire market. You can't escape that. And here's the key. The theory says the market only rewards you for taking on that second kind of risk, the risk that beta is supposed to measure. So the whole system needs an anchor, a starting point, and that anchor is the market itself. A big market index, like the S&P 500, is defined as having a beta of exactly 1.0. Everything else is just measured against that yardstick. Let's make this real. So you might have an aggressive stock with a beta of 2. What does that mean? It means if the market goes up 10%, that stock is expected to go up a whopping 20%. But, and this is a big but, it's a two-way street. If the market drops 10%, your stock is going to fall twice as hard. It's like putting the market's moves on steroids. And then, of course, you have the other side of the coin, defensive stocks. Let's say one has a beta of 0.5. Well, if the market has a great day and goes up 10%, this stock is only expected to go up about 5%. It's just less volatile, a much smoother, calmer ride. This all wraps up neatly into something called the Capital Asset Pricing Model, or CAPM if you want to sound like you know what you're talking about. And the promise of CAPM is just so simple. If you take on more of that market-wide risk, that undiversifiable risk, with a high beta stock, you should get paid more for it. Higher beta, higher returns. It's clean, it's logical, it makes perfect sense. The question is, does it actually work in the real world? And this is where the whole story takes a really dramatic turn. Because when researchers finally got around to digging into decades and decades of real market data, that beautiful, elegant theory, it just started to fall apart. The biggest crack in the armor came from this absolutely landmark study by two economists, Eugene Fama and Kenneth French. They looked at tons of stock market data, all the way from 1963 to 1990, and they were looking for one thing. Does beta actually predict returns? What they found was a total bombshell. The conclusion was just stunning. So they sorted all the stocks into groups based on their beta, from the lowest, safest ones to the highest, riskiest ones. And according to the theory, those high beta stocks should have absolutely crushed it, right? Higher rewards. But they didn't. When they looked at the returns, the relationship was basically a flat line. High-risk stocks weren't delivering high returns at all. You can imagine the impact this had. The financial world kind of freaked out. You had headlines in major publications just like this, literally declaring the death of beta. This simple core relationship between risk and reward, the one taught in every business school, was suddenly in really, really serious doubt. But here's the thing. The problem wasn't just in the data. Some of the most successful investors on the planet started arguing that the problem was much deeper. They said the very definition of risk that beta uses is just fundamentally wrong. And this really gets to the heart of it all. It comes down to, how do you even define risk? You see, for academics, risk is price volatility, how much a stock price bounces around. They love it because it's a neat, tidy number you can plug into a formula. But for an actual investor, for you, risk isn't just about a bouncy stock price. Risk is the very real danger of losing your money forever. And honestly,
Who better to make this point than Warren Buffett? He famously and very bluntly called the whole idea that volatility equals risk nonsense. For him, a great company's stock price dropping isn't a risk, it's an opportunity. It's a sale. Real investors worry about losing their money for good, not about temporary price swings.
And if all that wasn't enough, there are a ton of just practical problems with beta too. For one, a stock's beta isn't some fixed number. It actually changes all the time. It also totally depends on what you use for the market. You'll get a different beta if you use the S&P 500 versus a global index. But maybe the biggest problem of all, it's completely backward-looking. It tells you how a stock was, not how risky it will be.
So, you're probably thinking, okay, if beta is so broken, then what took its place? Well, the financial world didn't just give up. The failure of beta actually sparked this huge search for better, smarter models of risk. The key realization was this: trying to boil down all of market risk into one little number was just too simple. It couldn't be done. So instead of a one-factor model based only on market moves, researchers started building multi-factor models that looked at other sources of risk too. And guess who led the charge on this? Yep, our guys Fama and French. They didn't just throw beta in the trash. They built on top of it. They created what's now known as the three-factor model. So they kept the original beta for market risk, but then they added two more ingredients that they found also explained returns over time. Size, because small companies tend to be riskier, and value, because cheaper value stocks have historically done well. And that really brings us to the big lesson in this whole story. Beta was super popular because it was easy. It was convenient. It gave you one number to latch onto. But the market isn't simple, and it isn't convenient. Measuring risk is a messy, complicated thing, and trying to boil it all down to a single number, no matter how elegant it seems, is just bound to miss the bigger picture. So, I want to end this by turning the question back to you. After hearing about the rise and fall of finance's favorite number, how do you define risk? Is it just a bouncy stock price, or is it the real chance of losing your hard-earned money for good? Because figuring that out for yourself, that's probably the most important first step to becoming a smarter investor.